Given some of the changes that you talked about just now, Mike, how much does that change what floor you could see in your bear scenario for equities?
Well, I mean, look, we have to be flexible. We're trying to, also service a lot of different types of clients, right? Whether we're talking about trader types or we're talking about asset owners. For the asset owner crowd, we've been pretty adamant. We felt like the fall was a really good entry point where people had a longer time horizon. And if you added risk there, you probably just stay with it. I do think people, though, are getting a bit carried away on what they've been buying. Okay, so I think they're, given the rally that we saw in the fall versus the rally we've seen this year, they have very different sort of complexions, right? The rally in the fall was based on, we think, fundamentals, meaning rates coming down, economic data getting better because of China, globally at least, and that would help the kind of cyclical type areas of the market. Then we had this more speculative rally that started in January, kind of buying last year's losers, which was all the growth stocks and the meme stocks, whatever you want to call them. And those have just gotten out of control again, particularly in the context of higher rates. So I think there's a lot going on, right? And I think there's two ways to think about it. If you have kind of names that you want to own through, you want to underwrite through what we think is going to be a difficult time for earnings, and you say, look, I think there's value in this security for the next 3 years, great. You should just own those through that period. However, there's a lot of stuff that's gotten dragged along here that is wildly speculative now, in my view. It's actually somewhat reckless. And that's the stuff that you got to be really careful what's in your portfolio. Got to get out of there because that stuff has gotten revalued in a way that doesn't make much sense to us.
What kind of downside could you be talking about? And I assume you're talking big tech names as well as some of the other meme stocks.
Well, for some of this stuff, I think there's plenty of stocks that are probably going to go bankrupt. I don't think that's a crazy statement, but that's not the bulk of the stock market. Okay, so this is a pocket of the stock market, and then I would say, but overall, like the growthier stuff and the thing that even the cyclical names that have gone too far now could have as much as 20% downside, no problem. Our valuation work would suggest that even without the earnings recession, right, the valuations are kind of out of bounds again. So it's a stock picker's market. A lot of people are saying that. That's usually what people say, by the way, when they're having a hard time calling the direction of the market. We do it too. So everybody says, it's a stock picking market. Well, that's hard. Okay, so that's not an easy game to play, but it is a stock picking market, and the stocks that are likely to go up versus down is probably less than 50%. It's a stock picking market with not a great macro backdrop. So that's the challenge.